Hi, I'm sorry I was late. Sorry I was late logging in. Changing rooms. This hasn't helped a lot. Still very sunny here. George, can you hear me?
Yes. Hi.
Cool. Okay, so I had a really jam-packed webinar for today. I wanted to talk about, so this is my view. I wanted to talk about at the start of each month, free stocks that I'm willing to buy now, with the idea that this kind of constructs our conversation. And the idea is that I deliver this on Monday. People can have a look at it and kind of take these free and kind of just to see my thought process and what kind of things I'm looking at. So that had been the plan. Then GitLab reported results and they weren't very good. So I'm going to preload that, talk about GitLab. Then I'm going to talk about my top 3 picks, which are HIMS, Robinhood, Celestica. And then if I've got time, I want to talk about discipline. So I've got a lot to go through. I'm going to try to go through the kind of first part of this talk relatively quickly. I hope to be done in about 15, 18 minutes. And then I'm going to open it up to you for the Q&A. Just a second, there's somebody here that's, 1 second, I don't know who's making a noise here. Somebody, sorry, just for a moment, can you mute your microphone? No, it's talking.
How do you open the microphone? Can you hear me?
Yeah, I can definitely hear you. I can hear somebody else as well. Okay, I can't really figure this out. Whatever. Basically, so with GitLab, what happens is when you pick a stock, the way that I do it is I'm trying to get the inflection, the point where the company goes from reporting X amounts of profitability to X plus 1, for example, just whatever. And when a company reports its results, what the market is trying to do is trying to figure out what will be in 6 months' time the profitability as a typical run rate of the business, okay? So the market is reacting very quickly, trying to figure out what is an appropriate multiple to put on the stock. And what I'm trying to do is I'm trying to look ahead 12 months, and I'm trying to gauge that. And that's really what inflection investing is basically you're trying to buy into a stock that is growing. It doesn't matter really for our discussions whether it's something like PayPal that's growing at 10% or something like GitLab that's growing at 25%. It doesn't matter for our discussions. What you need to figure out is what the profitability of the business will be in 12 months. And I make mistakes, I clearly made a mistake with GitLab. And you are trying your best to get that. Now, in the case of GitLab, if you will notice, the revenues came out and it was okay. The revenues were okay. It was not a problem. The guidance, the revenue was fine. Everything hunky-dory. It's basically, I felt kind of going in is going to be around 25 to 20, maybe. I said, okay, let's put 25 to 30. Let's figure that out. I'll put 25. I'd like to be conservative. Hopefully I get a bit of a positive surprise, but let's start at 25. So they come out and they said, okay, we're going to grow at 27%, but we're going to be more conservative than we have been in the past. So they're kind of telling you, okay, 27 is what you're going to get, kind of suck it up. And when they did that, at 27%, people like, that's fine. That's, that's within the kind of the bracket that I was looking for. So that wasn't the problem, okay? So that's fine. But what I didn't foresee was that their profitability wouldn't be as strong as I had hoped. So the profitability year over year will be up, but it won't be up as much as I thought it was going to be, right? So this is really critical. And this is like, I'm spending a few moments to talk about that because I believe the reason why, you people come on the call is because over time, I've reflected a lot on my failures. And I would say probably the only thing that I'm actually good in life is reflecting on the times that I failed. I failed so much, man. I have failed like more than anyone, pretty much anything. Anyone on this call, I can guarantee, like, I failed more than all of you. But the advantage that I've got is that I like to spend a lot of time thinking about my failures. And I'm open about it. I'm transparent, like when things are not working, I'll tell you straight up, like this isn't working. And I don't care about like talking about things that are working, because when something we're talking now about investing, when something you buy something, it goes up, you're a genius, and like that's the end of the story. But you need to work really, really hard to avoid those losses, because the losses is what kills you. Everyone can make money when the times are good, everyone. And I can't remember, like I've spoken to so many people now, but I can't remember someone who was, so many people actually said this to me on last week. Oh, GitLab is reporting next week. The share price looks amazing. Shall I buy? Shall I buy? I want to buy with options. I was like, just, in this, when the market is going up, people get really confused, like, oh, everyone's making money. I kind of got to do something. And I say to people, like, like, don't believe that this is the status quo. Now, obviously, you guys listen on the call and the market is down today. So now my words do resonate more than they would have been on Friday, for example. But when you invest, for me, we all have our different reasons why we invest. For me, I'm super focused at the end of 2024 on delivering what I set out to deliver, which is 15% compounded. I said I would, I will. And well, I don't know, but that's what I work towards. So when I get up in the morning, I get up for that. Like I have this vision that it's going to be kind of New Year's Eve, and I'm going to talk to my family. I'm going to like, okay, I set out to deliver. And I also do it for an inspiration for my daughter, because I think that, the ultimate legacy that you leave behind is your children. But for you, I don't know where you are in your journey. You need to figure out why you're doing this. If you want to have thrills, like do something else. Focus on the losses. Really focus on that, narrowing down the process. So when I am trying to recommend a stock, I'm thinking to myself, okay, the business is growing at, let's say, in the case of GitLab, it's growing about 25%. If I buy on the 1st of January, assuming the profitability doesn't change a lot, and for hypothetical example, we're forgetting about interest rates right now. You buy on the 1st of January, on the 31st of December, the intrinsic value of that business is grown by 25%. But then you got a problem, right? Because then you got the valuation to work with, okay? So if that was all there was, everyone could figure this out, just buy the fastest growth and, you'd be done with it. So you're trying your best to buy something that in a year's time, someone else is just dying to buy from you. Like they just really, really want. Because there are things you can control and things you cannot control, right? Ultimately, what you're trying to do is buy low and sell high. This is common sense. But you don't want to be reliant on an euphoric market where you buy something and someone comes in and buys it higher than you. You want the business to be good so that when someone takes it off your hands in 12 months' time, they're not doing it because, markets are going up. You can't control where the market's going to be when you come to sell the business. You need to focus on the process very, very much. Try to focus on having enough stocks first. I always say, like, aim for like 14, 15 or something in that ballpark, okay? At the moment, I got kind of 20. I'm not particularly, I don't like that. It's a bit much for me. I like, causes more problems than it solves. But if you focus on the balance sheet, you start there, okay, look at the balance sheet, just try and get a gauge of it. And then starting from that, the balance sheet, you think about, okay, if the business is growing, and the best type is when it goes towards break even. So that's what GitLab is doing. But my expectations and people's expectations of where the profitability would go was closer to 10%. Now it's going to be around 2%. So that means I'm going to be sucking my thumb for like 12 months on this. And when the investor comes in 12 months' time, they'll be hopefully looking at something that will go to 10% then. But I bought it in the hope that it's going to be 10% now. So it's the reverse of when something like HIMS kind of pulls forward the profitability by 12 months. When HIMS pulls forward the profitability by 12 months, the share price goes higher. When GitLab pushes back the profitability by 12 months, that's like the reverse. Okay, so does anyone want to talk about GitLab now? Because otherwise I've already spoken quite a bit. I'm kind of dragging on. Does anyone want to ask some questions about GitLab?
One thing, I tried to read the earnings, but I don't understand everything there. But from what I understand, the revenue, so now we're talking about the guidance of the future profits, right?
Yeah.
So until now, the earnings were what they expected plus. So both earnings and the revenues were higher than expected. But for the future, they give a guidance that is what we expected for revenue, but lower for profit, right? Is it true?
Yeah,
or
that is correct.
So and they also say that this there's this 15 million that they okay, from this other company that we expect to stay long term, but then there is a 15 million that they only spend this time after 5 years because they are a fully remote company, and then they only do some meeting every few years, I guess, for everyone. But I mean, if we take out this 15 million, not the 30, but the 15, and we see that the revenue growth is still acceptable size, and then still we're only caring about the profits. So if we take out the 15 million of the one-time event, I guess, would this be still very bad?
Yeah, so that's why I said, okay, it's okay, it's not great. That's why I said straight away, because I said, okay, I'm going to put this at a hold. There are more exciting things that I can buy more. I'm not going to be recommending this as aggressively, but you're absolutely right on everything that you said. I'll just correct you one bit, that when it comes to investing, if you take nothing from me, take this. It never matters what the company did. Doesn't matter. Like, the company can do the worst thing in the world. That doesn't matter. What matters is what the guidance will be. Okay? So focus on that. Never discuss what happens. Like, that doesn't matter. What you're trying to gauge is the confidence. And that's why you need a company's performance in the past to gauge the confidence that you're going to have on the multiple that will be. So if a business is like Microsoft, year after year after year after year, growing the EPS number at about 25%, you have the confidence to pay a higher multiple versus another company that may, like in the case, for example, GitLab may also be growing the top line, not the bottom line in this case, but the top line by 25%, but you don't have a lot of confidence in that. Like, is it a flash in the pan? Are they going to be around in 5 years' time? What's the competition going to do? There's all these kind of questions. So you need to build that up. But when you look forward at the time periods that I'm looking at, which is 12 to 18 months, you need to figure out the multiple, because over this period, the multiple is really what's going to drive your performance. If you hold for a longer period of time, then it's kind of a bit, it's not my favorite type. I don't really like very much to go over that period of time. In my experience, it doesn't work as well. It's kind of like sometimes it works, sometimes it doesn't. I know that some people love to be buy and hold investors, but experience teaches me that people love to be buy and hold while the share price is going up, and then they're like, oh my God, I didn't sign up for this. So it's better for you to sell when times are good rather than being a forced seller when the times are bad. I should come up with a more witty expression for that. I'll figure that out. But yeah, essentially, did I answer your question?
Yeah. So a small follow-up. So if we had no idea about their earnings guidance and we
Mhm.
only knew about the revenue guidance,
Mhm.
would that look fine? Because from what I understand, like for me, it seems like more trustworthy of the growth of a company, what happens in the top line,
Mhm. Yeah.
than the bottom line, because the bottom line depends on so many things, like
Mhm. Yeah.
you know, yeah.
Yeah.
Sorry, I let you answer.
No, you're absolutely right. So yeah, it's more important to get that revenue line right. It's absolutely very, very important. And over a period of time, people will be more drawn, more attracted to that revenue line. But what drives the re-rating of the multiple is getting that profitability right.
Okay.
Yeah. Okay.
Okay,
Uh,
thanks.
sure. So I will talk about. I've kind of talked quite a bit. I'll talk about the free stocks that I was kind of interested in highlighting for you people. So I like Robinhood because it starts off with a balance sheet that has, I think it's 6 billion of net cash. So it's that's unrestricted cash, right? So it's kind of like approximately 40% of its market cap is cash. So if you start off with that premise, and the business is making significant amount of free cash flow, it gives you options. Okay, so I like that. Now, in the background of this, in the last few days, I've seen the Bitcoin is just exploding to the upside. So I caught a tailwind here, but that tailwind can dissipate. What I'm looking at is that customer adoption curve. They have a different metric, which is net deposits, the amount of money that the customers are putting in. That for me is really, really important, because if you have net deposits going up, then if you've managed to, throughout the last year, 2023, to remove a lot of your excess costs, then you're going to have a more profitable year in 2024, all else equal. But in this event, you also have, I call it custom adoption, but it doesn't really matter. Basically, the net deposit figures, I estimate it's going to be up about 40-45% in Q1 versus Q1 of the prior year. So you have more top line and more top line growth and more bottom line profitability, and you start off with a strong balance sheet. This, things positive can work, so that's the first one I want to talk about. I'm going through this kind of briefly, and I have all this written up. You can check it out, my notes. But I just kind of wanted to highlight this because some people kind of like, oh, what kind of stock shall I buy? I got some extra money. What shall I do? So I kind of highlight this. The other one that I really like is HIMS. And I say this a bit kind of like a little bit of a joke, that when I first recommended HIMS in 2021, it's now 2024. It's been a long time, man. I've been holding this. I've been holding this for a long time. And for a long time, everyone's like, oh, is it like Teladoc? And I was like, no, like it's very different. And they're like, oh yeah, it's like it's like the small version of Teladoc. And I'm like, no, like it's quite different, the business model. And presently, HIMS actually has a larger market cap than Teladoc. So I'm so delighted to finally be able to say, no, it really isn't. It's a very different business model. What I like, again, is you should know this, right? What I like is the fact that it has a very clean balance sheet, no debt. This is, for me, is very, very important when I look at the business to invest. If the business starts with a strong balance sheet, it just opens up a lot of options for you, right? No one cares about this kind of having this flexibility when the markets are going higher, but when crunch time comes, it's so important to start with a clean balance sheet because it gives that business options. Like you look at something like BlackBerry. I know BlackBerry, the phone is kind of died, but they had this other side of the business, which is cybersecurity, which was kind of okay-ish. They both have silence. You might not be very familiar with the story, but doesn't matter. The point is that if you have a business that has restriction on the balance sheet, it's just like cutting you up. It's like having asthma, you know, like, and you kind of like wheezing, like shortness of breath, SOB, shortness of breath, and you kind of like, it just restricts the business model. And it's kind of like that. So if you think about when you start with a clean balance sheet, it gives you flexibility to do other things. And if the business is profitable as well, then, you know, the multiple can be a question mark. Then it's like, oh, the business is growing and there's a strong customer adoption, and like people kind of run the narrative for you. And then, you know, but you need to start off with that strong foundation. So I think this is really, really important. And finally, I'm going to talk about Celestica. So Celestica is not like kind of bread and butter. I bought it, you know, I recommended it in January. I never would have hoped that it done so well. I bought it kind of quote unquote as a hedge because I had a lot of my portfolio in like these high growth names, which are really, really sensitive to interest rates. So interest rates go, like when interest rates come a bit higher, those just melt, like just ice cubes, they just melt. So I wanted to have these like things like Match Holdings, you know, the dating website. I wanted kind of these kind of businesses that are not as sensitive, so they're kind of more cheaply priced, but they're not growing as fast. So Celestica is kind of caught a nice bit of a wind there with like everyone's like jumping on the bandwagon for CSMI, which is super microcomputers. I'm sure you've seen all of this. Everyone's seen it like on social media. People just like drumming their chest and like, oh, I smoke cannabis and I like making 100K off CSMI and blah, 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 blah. And it kind of caught that wind in terms of the appetite for computing infrastructure is kind of just growing really, really fast. So I bought this as a kind of a quote unquote really no growth. No, it's not no growth. It's kind of unfair to say that, but it's like 10%. Like it's not growing very much. But it's really, really, for its size, it's quite profitable. So I kind of bought it on that aspect that it's really quite profitable. It's kind of picked up that wind and it's going up the share price, but it's still reasonably quite cheap, you know. So I kind of like that. I kind of waffled on quite a bit, and I'll just open up for a couple of minutes on the other topic that I had brought in to talk about. And I know I've waffled quite a bit, and I apologize for that. But I wanted to talk about discipline. So discipline means following the investment process when it doesn't feel like it doesn't feel fun, right? It's being quite restrictive on yourself and having this kind of very strict framework that you follow in terms of, for me personally, I like to have it equally weighted the portfolio. So you don't fall in love with certain ideas, you know, because you never know, like 1 minute the share price is going up and it's like, oh, like I'll buy more of that. Or the share price goes down and shall I buy the dip, you know? So discipline is following that strategy irrespective of whether the market is going up or down. And it's really, really important that when you buy into a stock, you let time lead your process. And it's not about trying to time how the quarterly performance will do, but you buy into a stock and you sit on your hands. And I know, because I've been doing this for a little while, that the thing that investors truly hate is having to be patient and waiting for things to happen. And there are periods, look, I've been very bullish on DraftKings, and for like DraftKings hasn't gone anywhere, but that's okay because it's in my process, right? It's in the process that I said, okay, I buy something, I underwrite it for 12 months, and then after 12 months, we'll see how it goes. So it's that process, right? I follow the process like that. And with, for example, now AppLovin is working out, but I recommended that, I think it was the end of August, maybe, can't remember now. And for a long time, that just didn't go anywhere, but it was okay because I was following the process. And you have to be really, really disciplined with investing, not to let your emotions guide you into what to do. Try to be really systematic about it in how you invest. Try and have different exposures to different interest rates. So personally, I find having some kind of growthier names and some less growthy names kind of helps me out a little bit. So yeah, so that's the topic I wanted to talk about. I've waffled on for a long time. I'll open it up for questions if people want to kind of discuss stuff. I'm sure somebody would like to ask some questions. You know, as I say, you know, these talks that I do are really for you because I know what I'm talking about, but I kind of want.
Yeah, I have a question on Robinhood.
Sure.
So the market currently feels like very excited. Everything goes up, or the feeling is like the internet area. So how do you think about, well, let's say from 2000, 2001, 2002, then the trading volume drops up, and not only trading volume, but the value of the market dropped up dramatically. How do you put those into your consideration on Robinhood?
Sorry, you said 2001 and 2002, or you mean 20?
No, in 2000 there was an internet bubble.
Yeah. Okay, yeah.
Yeah.
So,
now we have AI. Well, I don't call it a bubble, but a very excited investor. And with the Bitcoin going up, everything goes up. The people also, if you look at the chat room, people get excited.
Yeah.
So how do you consider that? If you look back to the 2000 experience, the market dropped dramatically afterwards, and the trading volume dropped up dramatically afterwards.
Yeah, absolutely correct. So yeah, markets absolutely go down very much, and there's no email to say it's going to go down. Absolutely. This is really, really important what you bring up. What the difference, in my opinion, between what was happening with the internet stocks, the .com bubble, blah, blah, and with the case of Robinhood is that it's making at about $1 billion of free cash flow. Now, obviously, a lot of that is deposits coming in, but it's the same with Airbnb. I don't know if you ever used Airbnb, but with Airbnb, you book on the system and you kind of pay a sum, an amount, before you go to the property. So it's called like deferred revenue. So you pay Airbnb some money, and then in 6 months, you go to the property and they release that money to the person that owns the property, okay? So they get a lot of cash up front. This cash up front, it's a technical term in accounting, is called deferred revenues. Same here with Robinhood. People come to Robinhood, they put money on the account to trade in stocks, to trade in Bitcoin, whatever. So you don't care about what people are trading. That doesn't matter. They take a fee from every transaction. Okay, so they're not like a charity or whatever. They take a fee, and the more the people trade, the more fees that they will make. So in the case of Robinhood, it's priced at around about in the ballpark. Well, it changes a lot from quarter to quarter, but it's in the ballpark of 20 times free cash flow, which is really a fair valuation for a business that is growing at about 20-25% on the top line. So it's growing and it's making cash. That's really what you want from a business. You don't want it to do anything else. It's really, really important when you invest to narrow down the focus and not get distracted by what people are saying in a chat room or AI, or you focus on the amount of free cash flow and where it's going up. And if you're
my question was, the cash flow for this year probably is 20%. Now, if next year the trading goes quieter, and the market drops dramatically because what I said, because the bubble, or because the excitement we have currently last year and this year, and the cash flow, the ratio probably goes up dramatically. That's what my question was.
So as long as people are depositing more, which they are, you can see that for the month, I think for the month up to January, you can see that they give you the monthly update, and you can see, and I understand that you don't know the future. Nobody knows the future, in terms of where the volumes will be going up. But you can see that over the past 12 months, more and more people are going to Robinhood. So it's not something that's happening today or happening in the last several weeks. You can go back over the last 2 years and see that there's been a steady amount. So when it was the pandemic, a lot of people went to Robinhood, and then a lot of people left Robinhood. So there's a lot of churn. But that churn has slowed down, and now it's inverted. So people are actually going more to Robinhood. They're going away from a place like Fidelity, where it's not as attractive, it's not as user-friendly. So people are coming away from those legacy platforms. So it's a brokerage firm that over the long period will continue to attract more and more people, which is happening. You can see it over the last 12 months. So there was a spike during the pandemic, and then the number of users came down because everyone left to go back to work. And that has churned, that churn has stopped, and now it's starting to pick back up again. And you can see that already.
Okay, thank you.
Michael,
Hiya.
Tom Moss here. I've been reading a lot about the electrification theme that you have, and the amount of electricity that these data center uses, and it just seems outstanding. And we've got to be in the early innings of these data centers being built all over the United States, and there's got to be some more plays on this really exponential growth that we're going to see in data centers over the next 2 to 3 years.
I agree wholeheartedly with what you're saying. You don't even know how much I've been reading about that. Like, I've just been buying books and reading, and my mind is blowing up with that. But at the end of the day, when it comes to investing, being early is the same as being wrong. And
I agree.
And I had this view, and you know this, I had this view on that, and my gosh, the problem is that you as an investor, from the moment that you buy the stock, the clock is ticking against you in terms of your stamina to stay with that stock. And you're not an entity that has, let's say, 5-10 years for something to eventually work out. You need to have a reasonable return within a reasonable amount of time. So you need to get in when things are actually, you have a very actionable stock to go into. While it's some kind of wishy-washy idea, which it's my idea. I own this idea. This is my idea. But I don't have an actionable way to go about it that is being translated into the market at this moment in time. But of course, I'm looking at this all the time.
All right. Have you ever considered on the electrification theme, have you ever considered copper, which is needed?
Yeah, I own that. I own Tech Resources, but again,
right.
I have been hearing about copper being in very, very short demand for 3 years, and for 3 years, man, that has not translated into the market. So at some point, I've just said, okay, it's much better for me to come out. I own Tech Resources, but it's much better for me to stop recommending this and just, put it on ice. Because what happens is you become entrenched with your own views, and that's really, really bad for the market, for investing. You cannot get entrenched. That's why I like to have a few different ideas in the portfolio, so that if something isn't working for me, Antero Resources didn't work, Tech Resource didn't work. If something isn't working, it's not causing me to, too much discomfort.
Good thoughts. I appreciate that. Thank you.
Yeah.
Michael, one quick question on Money Lion. Do you still have a lot of confidence in that? I realize the stock price is down a bit, but I don't own it yet. So what do you say about that?
So I'll tell you two things. Number one, George, you should know that, the question that you're really asking is whether the share price is going to go up after the results. I have no idea. No one knows. Even if you knew what the results are going to be like on the day, you have no idea. So that's really, that's the truth. What I will say is that there appears there's a competitor called Dave. It's kind of like doing similar-ish kind of things, like a neobank. They reported results this morning, and they have become reasonably profitable. So I'm thinking, hey, maybe this will also be the case with MoneyLion, but you never know. Even if I knew what the results are going to be in my face right now, if I knew it, you never know how the market is going to react. Like, so I kind of buy these things, and I just, you know, I know you don't like it, but I just kind of sit in my hands, and it's not sexy.
Yeah.
I know that, but yeah, man.
Okay,
Yeah.
thank you.
Does anyone else want to ask any more questions? Okay. Thank you very much. Really appreciate everyone coming, and hopefully see you next week. Thank you.
Thank you,
Okay,
Michael.
thank you.
Bye-bye.
Thank you very much.